Welcome to Hot Sectors with me, Punita Kumar Sinha. Here we take a 360-degree view of the sectors that have seen policy initiatives and analyze the challenges and investment opportunities that lie in them. Today we look at India's infrastructure sector, which is vital to India's growth and development. I'm joined by K. Venkatesh of L&T, Rajiv Lal of IDFC and Vibhav Kapoor of Island Affairs to discuss just that. I have with me K. Venkatesh, MD and CEO of L&T Infrastructure Development Projects Limited. Venkatesh, thank you so much for joining us today. Venkatesh, let me begin by asking you, what is your view on the recent push on reforms in the infrastructure sector?
There have been some bits and pieces of reforms in terms of withholding tax reduction to facilitate alternative instruments being raised abroad. Some reforms in terms of the overseas debt raising being liberalized. Some reforms in terms of forming that cabinet committee for investment, and so on. The place where infrastructure sector is poised today is mainly because of slowdown in implementation and slowdown in bidding, and of course the issue of capital, both equity and debt. So if you see, I've more or less covered the four pillars of infrastructure sector growth. And substantial reforms in each of these pillars need to be needs to be introduced, keeping in mind the current state of affairs.
Now, new project announcements have been in a declining trend. Do you think the current announcements are enough to reverse this trend? Do you see the investment cycle picking up?
It's a very wide-ranging spectrum of recommendations. Let's start on the capital side. It needs a substantially larger window and a longer sustainable tax status. The postponement of GAAR to 2016 is certainly extremely useful, but more importantly, there would be a certain need to reintroduce what was earlier 1023G, which is a certain amount of exemption from total income on interest being paid, interest being received by the banks, as well as capital gains tax on sale of shares. It was there about 5 years ago, and then it was withdrawn. On the debt side, just to give you a perspective of numbers, if you look at the next 5-year plan, we need to raise about $490 billion in terms of capital to fulfill the private sector target of 48%. Now, $490 billion, even if you take an 80% achievement, it would be about $340 billion, requiring more than $100 billion as equity and about $250 billion as debt. So if you really see a current market cap of all infrastructure companies put together, and if you exclude telecom from it, it would be about $45 billion. So you see the amount of capital that you need to raise is substantial, which means the existing developers have to churn their capital, which means you make brownfield assets attractive, and you need risk capital to come in for the greenfield assets. Now, how do you encourage capital is something that needs to be thought through, and that can only come through better agreements, more consistency in tax laws, and a rationalization across the sector in terms of all the finance-related issues. As far as debt is concerned, a lot of work is being done to formulate debt funds. They have to be put into practice.
Venkatesh, where are the trends most positive for a capex revival? Ports, roads, railways, or what else?
One is where the trends are most positive, and the other is what are the low-hanging fruits. In my opinion, roads and bridges, railways, MRTS, that is mass rapid transit, and power transmission and distribution are perhaps the quickest to start off in that order, actually. As far as power generation is concerned, there's a lot of incomplete capacity. And I think if those capacities get completed and the new projects kick off towards the latter half of the 12th five-year plan, then I think you'll see a lot of traction in generation as well. So, the real move has to be in two parts. One is to take stock of why projects have slowed down and which are the projects that have slowed down, and give them a huge push so that you get on to the growth curve. In the meanwhile, parallelly, don't repeat the same mistakes that you made as to the reason why these projects slowed down. And that, I think, should be the mantra for success.
As you know, stalled projects keep inching up. And a typical infrastructure project requires approval from 19 ministries and takes 24 months to execute. Will the creation of CCI really change that?
It will certainly help, but it depends on 3-4 factors. One is, how do we get traction between the state and the center? The second is, I've gone through the objectives of CCI. Now, they are very wide-ranging objectives, starting from policy-making issues to monitoring, to fixing clearance challenges, and so on. So how do you get the traction going between the center and the state on all these matters? So that's the second thing. The other aspect that I see is that how do you link the CCI with the financial sector improvements that need to take place between the RBI, the Ministry of Finance, the banks, the developmental institutions, and how do you represent a common face to the capital that has to come into the country from overseas? Because we certainly need a certain a substantial amount of equity to come in and a reasonable amount of debt to come in, keeping in mind the other factors of the economy.
Now, given increased competition, pricing and margins have been under pressure. What is your view on the profitability of the infrastructure space and whether that's likely to improve going forward?
Let me answer your question in 2 parts, because one is construction profits or supply profits. If you look at project implementation, what is the profit that comes out of project implementation to the agencies that are either building or supplying equipment to these sectors? Now there, I don't see profit margins coming down, and I'll tell you why. The sheer demand for this kind of stuff, and if it takes off the way we have been discussing, margins will not come down. But if there is continued slowdown, in which case supply will exceed demand, margins will be under pressure. And on the developer side, which is reflected by IRRs and valuations, the same theory applies to some extent. But more importantly, I think there are so many other factors into play that come into play. That is ease of implementation of projects, so that you keep your interest during construction and escalation under control, and also the cost of debt and the cost of equity. So there, I think we will continue to be under pressure for at least another 1.5 to 2 years.
In the various sub-segments of the infrastructure space, where do you see better returns and therefore will bid for new projects?
Well, I don't see any difficulty in any of the sectors except maybe irrigation, which is about 9% of the plan outlay. The margins will be under stress because of a lot of local competition, and invariably large players do not come into irrigation projects. Telecom has its own complexities in terms of equipment as well as installation. So I guess that's another area where I won't be able to comment, but I guess that's another area to be seen. Roads and bridges, which is 17% as given in the plan outlay, would see normal profit margins and IRRs. Railways is a completely new sector, so for expansion, I mean, it's an old sector, but substantial growth coming in from this sector, which is expected. That, I think, will give good opportunities for large companies. Power generation, well, I think, it's going to be under stress till those issues relating to fuel supply, etc. are worked out.
Thank you very much for your insights, Venkatesh. What can the government do to bring the sector back on track? Joining me is Rajiv Lal, MD and CEO of IDFC. Rajiv, let me begin by asking you, the 12th plan has doubled the projected investment in the infrastructure sector from the 11th plan. Who will make this investment?
The plan document basically projects that 50% of that $1 trillion investment is going to come from the private sector. Over the last 5 years, we have actually been very pleasantly surprised by the appetite of the private sector to invest significant amounts in the infrastructure space. What the learning from this experience is that actually financing is not really a fundamental problem. If we have a portfolio or a pipeline of attractive projects with relatively predictable returns, the capital is there. The issue is actually creating such a viable pipeline of projects.
That still means that there's a large requirement of equity with 30% equity and 70% debt. Where will this equity capital come from?
You're talking about, as I said, $100 billion a year in financing, of which $30 billion a year would be equity, $70 billion would be debt. In the scheme of things, for an economy that is as large as ours, that is not a very large amount.
What about deepening of the debt markets?
Domestic institutional investors in rupee bond markets have also been growing. I think slowly and steadily we are able to place more paper with the mutual fund industry. We have begun to access a small number of pension funds, and slowly but surely we are also being able to place paper with insurance companies. It will take time, another few years, before our insurance companies develop the track record and the balance sheet size to invest more in infrastructure.
What kind of returns can investors expect?
Between 15 and 20, 22 odd %, in that range. Theoretically at least, there should be a number of interesting projects that could be done in India.
But the 15 to 20% return number that you've mentioned, that's not what investors have received so far. So why will that change?
Investors in public equity markets have not received that return by investing in infrastructure, except for very short periods of time where you may have ridden up with the market. Promoters, on their own contribution, they were able to attract a lot more capital. So, if a project cost $100 or 100 rupees, the actual equity cash contribution from promoters wasn't very significant. The bulk of it actually came from third-party investors and debt providers.
Rajiv, the companies that you are lending to in the infrastructure space, do you find that these companies are having a hard time raising equity?
No, today they're having a very hard time raising equity, and that's because the whole policy environment in the infrastructure space is so uncertain.
And you're seeing that applying to the promoters as well, who were earlier plowing their equity back into infrastructure projects?
They'll be much more reluctant to plow additional money into infrastructure because they've been very disappointed with the results so far.
Rajiv, PSU banks have been seeing a lot of stress from the power sector. Why are you not seeing that kind of stress?
Because we had actually been careful not to underwrite very much or too much thermal power generating capacity. A very large chunk of greenfield thermal generating capacity. What we've done in energy is that we have done a lot of alternative energy, renewable energy first of all. So that has been one way for us to mitigate our risk. Secondly, we have funded operating assets. That has mitigated some of our risk. Third, we have funded projects that relied on either captive sources for the sale of electricity or captive sources for fuel. So that has protected our balance sheet.
Now, we've talked about power, but within the other spaces of infrastructure such as roads, ports, etc., where do you see the highest risks?
No, I think that the problems in roads are probably exaggerated. A lot of the problems in the road sector were really to do with procurement of land, which in turn was a lot to do with environmental regulations. So we are seeing some progress on streamlining of environmental regulations with respect to widening of existing roads. So once that happens, I suspect that some interest could return to the road sector. As far as ports are concerned, I think at least our exposure seems to be doing quite well, and we continue to look at opportunistically new ports to finance.
What would you recommend to investors on where to invest in the infrastructure space and what kind of returns they should expect?
Right. So the biggest opportunity in the Indian infrastructure space, notwithstanding all the problems that we've been discussing at some length, is really in funding or refinancing infrastructure assets that have already been built. Right. A lot of infrastructure assets are in long-term concessions. These concessions last anywhere from 15 to 25 to even 30 years. What we need now is to recirculate capital. So the initial risk capital that came to develop these assets can be freed up by another class of capital that will stay invested for the longer term based on predictable cash flows of operating assets.
So Rajiv, are you more confident about the infrastructure sector over the next 3 years than you've been in the last 3 years?
You're catching me at the cusp. I cannot say that with any confidence that I'm more confident for the next 3 years than I was if you asked me the question 3 years ago.
Well, on that note, thank you very much for your time, Rajiv.
Thank you.
We will now be joined by Vibha Kapoor of Ireland Affairs to talk about how the infrastructure sector is faring from a stock market point of view. Vibha, would you invest in the infrastructure sector from an equity market point of view? Are the low valuations of the sector what you like, despite the poor profitability?
See, on valuations, to address that question first, if you look at most of the companies and you look at their current profits and immediate projections, they don't look all that great. Some of them do, but a lot of them don't. But that is largely a function of the fact that profitability has been very severely impacted by all these factors in the last few months. Going forward, if interest rates come down and some of these measures actually take off from the ground, then the profitability of this sector should improve significantly going forward, and which means that since their prices have come down so much, the stock prices, if you look on a longer term basis and you factor in some of these assumptions, they would definitely begin to look cheap.
What kind of returns are you betting on for this sector? Especially for the long-term investors, what is the sustainable return you think?
I would think if most of these assumptions which we are talking about actually do happen, you could get a sustainable, growth of something about 15 to 17 or 15 to 18% over the next few years.
But 15 to 17% growth is only in line with nominal GDP growth. Is that sufficient return, you think, for the risk one has to take for investing in the sector?
Yeah, well, the nominal GDP growth I would take at least for the next, say, 18 months, 12 or 18 months to be somewhere in the region of 12 to 13%, with, say, a 6% inflation and a 7%, 6.5 to 7% real GDP growth. So I'd say, if you get 17, 18%, that's well above the nominal GDP growth rate. And as I'm saying, probably in the first, first few months after these reforms happen, you could really get a significant uptick more than the 15 or 18% we're talking about. But over a sustained period of time, I think 16 to 18% would be the type of returns I would be looking for.
What in infrastructure looks attractive to you?
You've got one or two companies which are right up there, like L&T. Then you have a few medium companies in the 1 billion turnover range, and then you have thousands or hundreds of companies which are really small. So I think over a period of time you'll really want to see that some of these medium companies which are in the middle level right now are able to scale their activity significantly.
Well, that's optimistic.
Thank you, Punita.
Thank you very much for your views, Vibha. Now let's talk to Tanveer Gill about what the rest of the market thinks about the infrastructure sector. Tanveer, what is the data showing to you?
Well, you have the industrials, you have the pure road project players, and then you have the conglomerates, Punita. So, the market broadly divides it into three segments. In terms of just the brokerage calls first, L&T, Cummins, stocks like IRB Infra, Adani Enterprises, Jayaprakash Associates, Reliance Infra, most of these stocks have more buy calls or hold calls than sell calls coming in there, with the exception of perhaps BHEL, where there's more of a bearish view. The best way to look at these stocks as I speak to analysts is on an EV per EBITDA basis, because that captures the debt value also for some of the projects, and also captures the execution risk that there may be for some of the projects that these companies hold. So, if you just take a look at the graph that come up on your screen, you will see that, companies where the project execution has already happened and cash flow generation has already started, their EV per EBITDA valuations will be higher, for example, in L&T or Cummins for that matter. From a 2012 return perspective, we've seen that L&T has done well, Cummins has done well, Jayaprakash Associates, Reliance Infra has done well. So the market also seems to be rewarding companies where already there has been a robust order book and execution of projects has happened on time. Punita, with that, well, given all the talk about infrastructure, what is in it for the equity investor, Punita? What's the opportunity?
Let's break it down by various segments. As you said, in the engineering space, companies like Larsen & Toubro, etc., their market caps are close to what we see, the rest of Asia. And those companies will do as well as, they can generate their earnings. Now you look at in construction, there we have a whole lot of mid-cap companies with very low market caps. But that segment will also improve provided the investment activity picks up. And if you look at earnings growth estimates, some of these companies are actually showing possibility of 20 to 30% earnings growth. Now the question is that sufficient to offset the risks that are existing in the sector? But if that happens, then there could be upside. I think interestingly enough, road sector is one where India is lagging considerably versus the rest of Asia. And the market cap of the Indian companies is very low as compared to what we've seen in other countries. So for instance, in China, there's a lot of road companies that are listed and their market caps are in the $2 to $5 billion range. So there's a lot of room for Indian companies in the road sector to re-rate to their Asian peers, provided, obviously we see that, there is investment happening and the road targets are being met. Well, that's my view. With that, we come to the end of this episode of Hot Sectors with me, Punita Kumar Sinha. Thank you so much for watching and have a great day.